Good evening, everybody. We are going to be starting here with a very excellent guest speaker. Dan Passarelli is one of the leading market timer option strategists. That's not the right word, but in the field. He's written a couple of books on options trading. Trading the Greeks and the market taker's edge. So he's got some very interesting trading strategies. So I'm not going to use up any more time. Dan, welcome to the Candlestick Forum.
Hey, Steve. Thank you very much. I'm really happy to be here. How's everyone today? So I am going to go through the presentation here today, and at the end, I am going to take questions. I'm actually not able to see questions during the presentation, guys. So if I don't answer you during the presentation, I'm not ignoring you. It's just that I can't see them. So you don't necessarily have to hold all questions until the end. You can send them in now, but I'll answer them later. Anyway, we have got a really exciting presentation today, the ultimate credit spread setup. This presentation is geared towards people who trade options or want to trade options. If you're brand new to options, you're going to get caught up pretty darn quick. If you've been trading options for years and years and years, you're going to learn something here today. So stick with me and you'll go far. Now, before we go anywhere, I need to point out that options are not for everyone. You should read characteristics and risks of standardized options before trading. You can get a copy of that by calling 1-888-OPTIONS. That's the home of the Options Clearing Corporation, here where I live, Chicago. All righty, let's talk about credit spreads. Credit spreads are one type of option strategy. Options, of course, there are calls and there are puts. Calls give the owner the right to buy the underlying stock. Puts give the owner the right to sell the underlying stock. However, you don't have to be an owner of the contract. You can sell options short. And in fact, selling options short is a very, very common strategy. Very common strategy. Now, those of you who trade stocks, you might not have ever shorted a stock. Those of you who trade options, you probably shorted options, and if you haven't, you will. Buying options and selling options, though equally common, they're very different, of course. For an option seller, your goal is simply to buy back the option for less at a later date, or simply just watch it expire, worthless, which is like buying it back at zero. Now, there is a certain advantage to being an option seller. There's disadvantages too, but let's talk advantages first. As each day passes, any option gets one day closer to its expiration date. It loses one more day of its life. And that means it gets worth just a little bit less every day, all else held constant. This is a phenomenon called time decay. When options lose their value as time passes, that is called time decay, and it is measured by the option Greek theta. That's the benefit. You've got time working for you. Here's the potential detriment or the risks. Whenever you sell an option, the most you can possibly make is the price you sold the option for. So, for example, if you sell a call for $2, the most you can make is $2 a share. For securities options, that's $200 of cash, but that's it. Maximum profit potential. That's it. However, your risk can be unlimited. You can lose a lot more than $2 if things really go wrong. So you got this great thing working for you, time decay, but you got this potentially catastrophic thing working against you, unlimited risk. So, clever option traders must have a way to overcome that obstacle of unlimited risk, and there is indeed a way. It's called the credit spread. Credit spreads enable traders to sell options in a fashion that has limited reward, of course, but also limited risk. There's two types of credit spreads, call credit spreads and put credit spreads. A call credit spread is when you sell a call, at or out of the money, and then you buy a higher strike call, that is a call that has lesser value, in the same month on the same underlying security. Now, of course, we call it a credit spread because the option you're selling that you're collecting money for when you sell it is worth more than the option you're buying that you're paying money for. So the trade is actually established for a credit. Now, credit does not mean profit. Credit just means credit. It's just like shorting a stock. If I sell a stock at $50 a share, for each 100 shares I get $5,000 put into my account. Later, I'm going to have to pay to buy the stock back to close out the position, hopefully take a profit. If I pay $48 for that 100 shares, I made $2. This is how it works with credit spreads. I'm going to put on the spread for a credit, and later I'll either buy back that spread or I'll just simply let it expire. And if it expires worthless, that's like buying it back at zero. Put credit spread is kind of the same thing. It's its close cousin, but just a wee bit different. It's using puts instead of calls. So the put credit spread, a trader sells a put, usually at or probably more likely out of the money, and then buys a lower strike put with the same month on the same underlying. And so, of course, that lower strike put would have lower value than the put being sold, thus established at a credit. So you've got two things going on here. Now, you heard Steve tell you that I wrote a couple of books, and my first book was called Trading Option Greeks, Delta, Gamma, Theta, Vega. Those are the option Greeks, and they measure different exposures, if you will, potential for profit or potential for loss. Don't get intimidated by these if you've never worked with them before, you never heard of them before. Delta simply measures your exposure for direction. With credit spreads, call credit spreads or put credit spreads, a trader can make or lose money if the underlying stock changes direction. That's measured by delta. Now, volatility also, that's a little bit more esoteric. And those of you who are brand new to options, you can get a little confused by this. I know from experience teaching people, I've been doing this a long time, volatility is a confusing subject. But there is a valuation component of all options called volatility, or rather implied volatility. You can think of implied volatility as how cheap or expensive options are based on the market's expectations for future volatility. A better way to think about it is like your car insurance premium. Driver A has a perfect driving record. 35-year-old, woman in the suburbs, never got in an accident, just drives to the grocery store once a week. Her insurance is going to be pretty cheap, I think, right? Driver B is an 18-year-old kid, a guy with a red Corvette who likes to drive 90 miles an hour and has crashed his car 13 times in the last week. His insurance premiums are going to be sky high. Why? Because the insurance company perceives him to be a much more volatile driver. Better chance of loss. That's how options work. When the market expects a stock to be really volatile, better chance of loss, the options get more expensive. It's because the volatility component, called implied volatility, makes them more expensive. This is an important consideration of credit spreads as well. we need to consider both direction and volatility and attempt to profit from both of them when we're trading credit spreads. Now, here's some guidelines that'll take you far, whether you're trading credit spreads or any option position for that matter. Always know your max gain and max loss. Here with credit spreads, you can only make what you collect when you trade the spread, and your loss is also limited. Know what that is? I'll show you how to figure that out in a minute. You want to structure this as a high probability trade. You hear people talk about credit spreads. This is why. Credit spreads can be structured as high probability trades. They can be set up where if I make 10 of these trades, I'm highly likely to win on, at least 8 of them. This is a tremendous advantage as well. We want to structure them with at least 2 weeks until expiration and no more than 2 months until expiration. Now, the 2 months, that's a rule as far as I'm concerned. Never create a credit spread that has more than 2 months until expiration. Why? Because the less amount of time that you have until expiration, the less amount of time that you have until expiration, the higher that rate of time decay. That's good. Less time till expiration means your options lose value faster. Benefit. Don't trade real long-term credit spreads. Now, the 2 weeks, that's kind of arbitrary. If you can find a good credit spread with less than 2 weeks, go for it, my friend. But they start getting kind of hard to find when there's less than 2 weeks. Many of you might be familiar with weekly options. Options that expire, when they're first listed, they have about a week until expiration. Those become really attractive, and they're great for option selling strategies like credit spreads. But it can be tough to find a good credit spread trade in a weekly. Look for them, but don't be upset if you don't find one. Also, volatility is the name of the game with options, especially with credit spreads. You want to avoid it. Credit spreads are spreads where if the market moves too much, particularly in the wrong direction, you lose money. If the market moves just a little bit, even in the wrong direction, you can still have a profit. Big volatility is bad. So avoid it. Don't put on a credit spread if earnings falls before the options expire. If earnings is coming, don't trade a credit spread. If there's any other big news expected, don't trade a credit spread. If the market's moving around like crazy, you might want to be pretty darn careful putting on a credit spread. So here's the setup, okay? This is, an introduction for many of you and a brief presentation, but, this is how I do it. I'm kind of telling you, I guess my secrets, if you will. There's a lot more to it, of course, but I'm giving you the basics of exactly how I do this. Here's how you set up a credit spread. Start with direction. Start with your technical analysis. Now, you guys are students of Steve's, or at least some of you are. If not, the rest of you are thinking about it. He can help you with that. He's the master at candlesticks. You want to read charts? He's the guy. He's going to show you how to do it. You're probably really, those of you who are students of Steve's, you're probably really good at figuring out, direction and that kind of thing, reading charts. Perfect. Now you can take that knowledge and put it to use here with credit spreads. Now, a lot of chartists look for breakouts. They look for stocks that are about to break out of a pattern, make a big move up or a big move down, and capitalize on it. Sometimes, though, you look at a chart and you see, it doesn't look like this stock's going to break out of anything. It looks like it's just stuck in a range and it's a really boring stock. Perfect. You just found a great potential credit spread candidate. We're looking for super boring stocks that are trading in a channel. They get down to support, they bounce off it slowly, they get up to resistance, they bounce off it slowly, bing, bing, bing. It's like bumper bowling. These are the stocks you're looking for. We're going to coincide our short strikes with support or resistance. We're going to look at a chart in a minute. I'm going to show you exactly what I mean. Next, we move on to volatility. We're selling options. Therefore, we're selling volatility. And I know that might seem like a kind of obscure, esoteric thing to say, we're selling volatility. But we are. Think about it. You want volatility to be low, like we said. You don't want a big move in the wrong direction. So therefore, we're selling volatility. And we're selling that component of the options premium that's a function of volatility, that sort of insurance policy premium concept. We want the options to be a little bit expensive. We might not want to be the insurance company insuring the 18-year-old kid with the red sports car who crashed it 13 times in the last week. But you know what we do want? We want to be insuring a regular old driver and an area where the premiums are actually too high. We want to cheat a little bit. Sell expensive insurance that's actually too expensive. That's what we want to do. And we're only going to trade credit spreads if that's the case. So, these prices are not current. Okay, I'm using a historical example intentionally because this is a gosh darn perfect example. And, I don't want you to think I'm recommending anything. I'm just showing you how to find these and set them up yourself so you can do that. All right. Johnson & Johnson. Look at this. I start with the weekly chart. These are weekly candles, and I've got resistance at about $67 a share. $67 a share is a pretty significant area on this chart. Just a few days ago, stock broke up above 67, and resistance becomes support. That's the weekly chart. The daily chart, lo and behold, take a little look at this. $67 a share is also a significant price level in J&J on the daily chart. It was resistance for about a year. And about a month ago, the stock busted out above 67 and resistance becomes support. Here is the opportunity. This is called a profit and loss diagram for a put spread. The idea is we would sell the 67.5 puts. We'd like to sell the exactly 67 strike puts, but there are none. So we do the next best thing, sell the 67.5 puts and buy the 65 puts. That's our spread. I'm going to show you an option chain and show you all the prices in a minute. I want you to get the concept first. Here's the idea. Whatever we sell that spread for, if the stock stays above 67.5 between now and expiration, both of those options expire. That means whatever we sold that spread for is ours to keep, max profit. We want the stock to stay above our strike price of 67.5, which pretty much coincides with support. As long as the stock stays above support, we got ourselves a winner chicken dinner. Now, the definition of support or resistance is, this is an area that the stock has shown trouble crossing. So we've got a little bit of an edge here. We've got some probability on our side. There's a better chance than not that the stock stays above support because, it's support after all. In this example, the volatility of the options was actually a little bit elevated. I'd love to see it a little bit more elevated, but I'm great with it. I'm fine with it. the volatility was about 13.5. That's what this brown line represents, implied volatility. It's about 13.5, where just a month ago or so, it was about 10. So it's higher than it's been. It's in the top half of its 6-month range. And it's a little bit above historical volatility. This means options are just slightly expensive, which is awesome. It's perfect. That means that you get a bigger credit. You're selling the options for more than you otherwise would. You get to cheat a little bit. You get to charge a higher insurance premium than you should be. That means your maximum profit is bigger than it should be. But that also means your maximum loss is smaller than it should be. You get to kind of double dip here in the land of statistics. That's because your maximum profit is the credit received when you sell the spread. Your maximum loss is the difference between the two strike prices, 67.5 minus 65, minus the credit received. So the bigger this credit, the lower this potential loss. So here's the spread. Sell the 67.5 puts at 82 cents. Buy the 65 puts at 21 cents. That's 61 cents. So look, if Johnson & Johnson is above 67.5 at expiration, the trader trading the spread keeps that 61 cents, reaches his maximum profit. The odds are in favor of that. You know, it's not guaranteed, but the odds are in the favor of that. If the stock falls below 67.5 and is trading there at expiration, winner might be a loser. Depends on the volatility. It depends how far the stock falls. The break even is 67.5 minus 61 cents, or in this case, 66.89. As long as the stock stays above 66.89, by expiration, the trade is a winner. Now, with support at 67, our break, the support level, I like it. I like this trade a lot. Now, if there is a big move to the downside, and the stock falls below 65, that's where the maximum loss would occur. And, you know, think about it. If the stock is trading below 65 at expiration, the 67.5 puts would get assigned. You'd have to buy stock. But you would exercise your 65 puts and sell stock at 65. So you'd lock in a loss of $2.50 minus the 61 cents you initially collected, and you can lose up to $1.89. So the strengths of this spread are this. We've got direction in our favor. The spread has some support. It has some momentum heading up, like especially when stocks go down and bounce off support and start heading up again. Oh, man, that's it. That's what we like to see. The probability of future directional movement is to the upside. Now, again, I speak in terms of probability. You can't predict with certainty anything. But the probability is to the upside. That makes this a statistically advantageous trade with what I call edge. As far as volatility goes, implied volatility, that is, remember, that's option prices, take the insurance premium analogy, is high. Not super high where, you know, we're scared off and we don't want to insure this kid because we know he's going to crash his car. But just high enough where we're thinking, you know what, we're getting paid enough to assume this risk. I like this spread. This makes the spread more attractive from a maximum profit and a potential loss standpoint. So the takeaways here are this. This is a simple series of analyses. We're going to look at a chart. We're going to go with directionally biased stock, slightly directionally biased, not looking for a breakout, not looking for a big momentum trade, just something that bounced off support for put spreads or bounced off resistance for call spreads that has elevated volatility slightly no earnings coming out between now and expiration, and we'll just kind of do a little sanity check here. How do the prices line up on the option chain? Are we selling it for enough? Does it just gutturally feel like, okay, you know what? I'm getting paid enough to put on this trade. I like the maximum profit. Okay, this is good. You got to have a plan when you do this, and I'm going to tell you a little bit more about how to develop that plan right now. I know there's a lot of questions waiting there because you guys patiently waited until the end of the presentation, and I am going to stick around and I'm going to answer all the questions that you guys have because that's my favorite part of giving presentations. But first, I want to tell you about something I'm doing. I'm putting on a class called the Income Trading Master Sessions. Spreads like credit spreads, they're called income trades because you set up these high probability trades, and most consecutive months, you make money doing it. The months when things go wrong, you need to know how to manage them so that you can turn a loser into a winner. I'm doing a 6-part class all on income trades. It's 6 different classes, 3 weeks, twice a week. I record the classes. You get access to the recordings, plus you get a bunch of special bonuses. Here are the dates of the classes. I'm going to show you how to find trades, analyze them, leg into them. I used to be a market maker down on the floor of the Chicago Board Options Exchange. Those are the guys that take the other side of your trades. I was one of those guys. I was one of the guys that you would be trading with. I know a non-market maker, you guys need to know to trade against the pros. I'm going to teach you those things in this class on September 17th. I'm going to show you some more complex income trades too. And then I'm going to show you the most important part of all this, how to adjust them when they go wrong so you can turn losers into winners. All these classes are presented live on those dates. If you can't make a class, no problem. They're recorded. If you just want to review the class, no problem. They're recorded. You'll have access to the recordings for 3 full months. And I'm going to give you $1,700 worth of bonuses. If you open and fund a new Trade Monster account, they're a great online options broker. Bucks back right off the top. I'm going to let you into my Market Taker Live Advantage group coaching for free for 2 months. That's classes twice a week, Tuesday and Thursday mornings, a half hour after the market opens. You watch my head coach finding trades in the live market. He finds about 20 trades per class. Over a 3-month period, that's almost 500 trades that you'll watch him find. And, you know, if you make some of those trades yourself, more power to you. That's a $500 value. I'm going to sign my latest book, The Market Taker's Edge, drop that into the mail to you today. It's a $35 book. And you're going to get 3 months of unlimited email access, a hotline to our head instructor. We value that at about $1,000. Really, it's priceless. It's like having a professional right there in your pocket. You get all this for $599. With all those bonuses, that's almost $2,400 of value, of real value, that you're getting for $600. So you get all this, a 6-part class, the recordings, $250 off the top, so it's really $349. 3 months of group coaching, my book, and unlimited email hotline. If you sign up right now, go to markettaker.com/SB. That'll take you right to the sign-up page, and you can sign up now, and I will drop your book in the mail with my autograph in it. First thing in the morning, you'll get it next week, and you'll be ready to go, and you'll be able to take this class. It's just $599. You get $250 back when you open and fund a Trade Monster account. markettaker.com/SB. Now, I'm going to put this back up in a minute, but I want to be able to answer your questions. And Steve just put in chat that you can just simply click on to sign up. So you don't even have to remember that link. Just go down to where it says General Chat, see Steve's name in blue, and you can click that link. Now, I am going to scroll, and I'm going to answer some of your questions here, guys. Okay. There was awesome music on the intro. I like that. I am a music guy myself. Okay. OP says credit spreads always offer more risk than reward. Yes. Okay. With options, right. With options, statistics always come into play. Imagine, for example, you were going to play the lottery. You buy a Powerball ticket, and I think right now, I don't follow it that closely, but I think it was about $50 million the last time I looked. You pay $1 and you can get $50 million. Imagine if your chances were 50-50 of winning. Wouldn't you go out there and buy some tickets? Of course you would. But it would be ridiculous for the people who run the lottery to make the chances of winning 50-50 if they're going to give you $50 million for $1, right? With games of chance, there's always a relationship between risk-reward and probability. That's what we have here with credit spreads. Your probability of winning is high. So your risk-reward is going to be disproportionate and reflect that. So that's why it's like that. Invader says credit spreads and debit spreads with the same strike prices have identical risk. Yes, indeed they do, my friend. Okay. And Invader says near expiration gamma is also a major risk. Indeed. Now I'm trying to gauge the audience here, and I couldn't see questions, so I don't know exactly how advanced the audience is. What Invader Zim here is saying is basically he's putting the fancy Greek words onto what I explained in a maybe a little bit simpler of a manner. Or at least a little bit more user-friendly of a manner. Negative gamma means movement hurts you. And that becomes more extreme as expiration approaches. So, yeah, Invader Zim, you're absolutely right, my friend. Movement becomes a greater risk near expiration, right? And Leon says, Mom and Dad should take the red Corvette away. You're right. My first car was a Ford Escort. Ugh. With no radio. It's terrible. And says, just don't take my Kodachrome away. Yes. Okay. Dan's voice is coming in and out. I apologize if it was. Okay. Recording should be fine. I think it was going to say, and then the resistance. I don't know what you're saying. That's low. I don't know. Hello. Hey, John. How are you, my friend? John, I've been seeing John in these presentations for a long time. Okay. Let's see. If the stock drops, okay. That's not necessarily a question. Okay, Mike has a great question. Can you do this if you own the stock? Well, can you? Yes. But it's going to be a little bit different. Your risk reward is going to look differently. Doing a put spread like this, if you own the stock, you're going to have greater profit to the upside than that indicates. You're going to have greater loss to the downside than our profit and loss diagram indicates. Glenn says, how much open interest is considered acceptable for credit spreads? You know, Glenn, that's a great question. I talk about this all the time. It depends how big of a trader you are. If you're a small trader, you trade 1 lots or 5 lots. What you really care about is how tight the bid-ask spread is. And open interest then doesn't matter quite as much because you're always going to be able to get off a 5 lot. When you start doing 100 lots and 200 lots and that kind of thing, then you got to care about open interest because that's going to reflect the depth of the liquidity. So, you know, if you're a small trader, don't worry too much about it. If you're a bigger trader, I don't know, probably want, let's say, 500 contracts open interest. Roger says, how many hours is each of those classes, the six classes? Each class is 1 hour on those dates. So it's a full 6 hours presented live and then recorded. And I know you're going to go back and you're going to review them. I mean, it's hours and hours of learning. Plus you get that email hotline. If you have if you missed the class and you're watching the recording and you have a question, no problem. Email us. If you have a question about something totally unrelated, email us. We're giving you a professional in your back pocket for 3 months. I mean, it's an incredible value. Like I said, we value it at $1,000, but it's worth a lot more. Rodney says, when volatility is dropping, do you find it cheaper to buy debit spreads than credit spreads? Meaning the credit is slightly smaller than the cost of the... Yeah. Well, to somebody's point earlier, actually, debit and credit spreads are synthetically identical. I don't want to get into too fancy of stuff here. But how debit spreads and credit spreads are conventionally traded when they're both, out of the money, they're kind of traded differently, as if they're not synthetically related, even though they are. So, given that this is a little bit more of an introductory class, Rodney, I don't want to get too into that. I'm going to talk about that a ton in my 6-hour class, 6-part class. But they serve different purposes, even though they're actually identical. Let me just leave it at that. If you have other questions, you can email me, Dan@MarketTaker, and it might be a better forum for answering that. Julia says, where do you find the volatility chart of JNJ? Great question. You know what? Your online broker should have volatility charts. So, that's no problem. You should get those charts through any option-friendly online broker will offer them. Lena says, is the class for beginners with no experience? Yeah, my 6-part class is for beginners and intermediate and advanced. I know that sounds kind of crazy, but here's how I view the world. There's not beginner, intermediate, and advanced traders. There's traders who have the information they need to trade and traders who don't. So I start out and I give you the basics that you need, and by the 6th class, I'm ramped up to more sophisticated topics, but I take my time. I mean, the feedback that I get from my students is that I do a really good job at making complex topics simple. I explain things and I make things very approachable. So if you're a beginner, you're fine. You're in it. And plus, with the group coaching, with the unlimited email access, and with my book, you're going to get caught up to speed right away. You're going to love it. And Steve, thanks. Steve has put that link up here. All you have to do is click it. You don't have to remember the link, but it's markettaker.com/SB, or this link here will work just fine too. Roger asks, do you prefer the implied volatility to be in the upper third of the range? Yeah, Roger, you are right on the money. That is exactly how I would phrase it. In fact, I think in one of my books, I lay it out that way. The implied volatility should be in the upper third of the range. How do you manage the positions when the stock takes off on a 4-time standard deviation move? Yeah, Jim, great question. Every once in a while that happens. Not too often, but it does sometimes. You've got to be good at adjusting. This was a short presentation. I mean, that's why I have a 6-hour class, because I can't cram it all into a 1-hour class. In order to really be successful, you have to be good at adjusting. And don't get me wrong, there are going to be times where, you just, bam, end up at your max loss overnight because of some big news or a market crash that happens. And sometimes there's not much that can be done. You can just do an adjustment to make your losses less. But a lot of the time, you can do an adjustment to overcome your adjustments in entirety. Mini Mike, hey, how are you? Can delta be used to assure probability? Well, look, Mike, delta is important, and you can use it to ascertain the probability of an option expiring in the money, or from the flip side, expiring worthless, right? If it's not in the money, then it's out of the money and would expire worthless. So yeah, you can use delta to estimate probability. Sure is not a good word. Estimate is the right word. Lena says, will the class cover calendar spreads too? Lena, you betcha. As Sarah Palin would say, you betcha. We will absolutely cover calendar spreads, credit spreads, iron condors, butterflies, double calendars, diagonals. Yes, we're doing all the income trades in that whole income trading family. So if that's what you're looking for, that's the right class for you. Jean-Pierre says, could we use credit spreads with all brokers? Well, Jean-Pierre, here's the deal. Some brokers don't understand options and don't even offer options. So obviously you can't with them. Some offer options, but they don't really get them, and they limit traders from trading. If you want to be an option trader, don't use those brokers. But any full service options, or not full service, any option friendly online broker will let customers trade credit spreads. Now some have levels. You get approved for level 1, you get approved for level 2, you get approved for level 3, and so on. They'll start you out where you can buy calls and buy puts. And then they'll let you do covered calls. Then they'll let you do spreads. So it's case by case. You kind of have to talk to your broker. Trade Monster, with this class, you get the $250 back with Trade Monster. You can do spreads with them. They get it. That company was founded by option traders for option traders. JK says, did you do any trades for any of the earnings out today? I did not, my friend. No. Anything that had earnings coming out after the close today, I did not do. Jose says, will the $5.99 still hold if we don't open a Trade Monster account? Yeah. If you don't want to open a Trade Monster account, it's still only $5.99 with $1,700 worth of bonuses. So, big whoop. You miss out on the $250 back, which is nice, but geez, for 500 trade ideas over 3 months, an unlimited hotline, plus the class and access to the recordings for 3 months, I still stand behind saying that's a great deal. Steve says, when you close out a trade, or when do you close out a trade if it's not working out? Any guidelines or rule-based system? Yeah, Steve. Most of the time, what I like to teach my students to do is to adjust so that you don't eat the whole loss. Every once in a while, if you're a brand new trader, if it goes against you and you're down, say 30% of what would be your maximum loss, there's one rule you can go by. It depends on your risk tolerance, and again, that's really only for newbies. I like to teach you how to adjust so that you can attempt to overcome the losses. Maybe not in entirety, but stem them, make them less, or maybe reverse them altogether. Diane says, what if we already have a funded Trade Monster account? Well, Diane, you can open and fund a new one, maybe move your IRA, or open and fund a new one. That's one way around it. Or like I said, the $250, yeah, you want that, but still an incredible value even without that. Peter says, how can you trade credit spread for Apple? Well, Peter, I don't have an Apple chart in front of me here. I don't have my brokerage account open or anything. But, for all stocks, you basically do it the same way. You'll look for support and resistance. For put spreads, you have the short strike at or below support. For a call spread, you have the short strike at or above resistance. And that's how you do it. Now, you also have to keep in mind, you can't just put it on autopilot and say, oh, there's resistance, trade the spread, okay, done. You have to look and do a little due diligence, do your homework, and think, okay, well, do I think this support's going to hold? Or, if you think it's going to break through support, you can't do this. Or do I think this resistance is going to hold? You want it to hold. You want it to stay in the range and everything to stay status quo. Chuck says, you mentioned debit spreads compared to credit spreads. Can you explain the difference? Yeah, sure. Though they're synthetically the same, and I know I keep saying that, and that's really just for the super more advanced people, but even though they're synthetically the same, they're kind of the exact opposite. In fact, they are the exact opposite. If I sell you a credit spread, then you just bought a debit spread. Okay? Basically, there's a call spread. The trader on one side of it traded the debit spread. Trader on one side traded the credit spread. So with a debit call spread, I would buy a call and sell a higher strike call. Just the opposite. Put spread, I'd buy a put and sell a lower strike put. Okay, SS says, please explain the difference in historical volatility and implied volatility and how it affects your trade setup. Yeah, absolutely. Historical volatility tells you how much the underlying stock has moved in the last 30 days, though the figure is annualized. Implied volatility tells you in that same context, annualized volatility, or annualized standard deviation specifically, how cheap or expensive options are. So you want today's implied volatility to be above historical, between 2 points above and 20 points above. And then, there's a little bit more volatility analysis, but that's the gist of it, just in the context of historical versus implied. Donna says, I assume based on the last few volatile days that it's not a good time for credit spreads. Yeah, I mean, the last couple of days have been a little trickier for credit spreads. If you pick your spots and you get in at the right time, it could have been okay, but you had kind of exactly the opposite of what you want. You had low implied volatility and volatile stocks. So, yeah, it's been pretty tricky lately, but, usually these are trades that most trading days you can find good ones and you can use it over and over and over again. And every once in a while, like the last couple of days, it's a little bit trickier. Roger says a good volatility website is ivolatility.com. I concur. I think it's a good site as well. Robert says, what is the risk-reward ratio you shoot for, Dan? Great question. I like to risk, depends on the scenario, but let's say risk 3 to make 1, okay? So let's say that the strikes are $10 apart, like something like Apple. I'd have my maximum profit of $250, my maximum loss of $750. Now that depends on how high the probability is, how far the strikes are away from the money, how much the stock's been moving around. It depends, but you're looking for a single answer. I'm going to give it to you. Risk 3 to make 1. Mark, hey, how are you, Mark? Mark is one of our one-on-one coaching students here. He says, been a student of Dan's for about 4 months. He and John are excellent teachers. Their programs have been invaluable. Thank you very much, Mark. I very much appreciate that. And we love having you as a student. Let's see here. Rose says, okay, buddy. Let's see here. Peter says this is U.S. stock options. Yeah, I mean, my classes are all in the context of U.S. stock options, but I mean, I teach futures options. I teach, whatever. The concepts apply to any options, but I do teach in the context of U.S. securities options. I've got a lot of Canadian students who just apply these concepts to the Canadian option market. Brian says, do you trade weeklies or monthlies or both? Well, Brian, more monthlies than weeklies, but when I can find a good weeklies credit spread, I jump on it. Like I said before, a little tougher to find, but when I can find them, I trade them. I trade them. Let's see here. Oh, I just lost my place. Here. Hold on a second. Okay, let's see what else we have here. Gold trader. What sort of stocks do you like to trade iron condors on? I like to trade iron condors on really super boring stocks. Johnson & Johnson actually is one that I do a lot of income trades in general. Probably a lot of iron condors, but sometimes just, credit spreads, sometimes calendars. 3M is another one. Just really boring stocks that, don't move a lot. Roger says, do you have a minimum difference of the delta that you like, such as one strike at a delta of 47? No, you know what, Roger? I know that there are some people who use delta to set their strikes. I don't. It seems like that's more in stone, but it's actually more arbitrary. Support and let the market tell you what to do. Don't try and fit your strategy. Don't try and make the market fit what your delta is. Let the market tell you what strikes to use. That's why I use support and resistance. Chuck says, with Trade Monster, can you trade options in your IRA? I don't work for Trade Monster. I like them, so, talk to them. I think the answer is yes, but I can't speak for them because I don't work for them, but, I think any option-friendly broker is going to let you trade certain options in the IRA. You can't sell naked options, I don't think, per SEC rules, but you can do covered calls and that kind of thing. Yeah, Peter, I don't know the answer to your question. You're asking about taxes and that kind of thing. I have an accountant do my taxes. I don't talk about taxes. I don't know. I'm not a tax expert. I'll be the first person to tell you that. Okay, yeah, Maggie, I've had an account there in the past as well. They're fine. MJ says, what is the minimum dollar to start an account with Trade Monster? Go to that page, and Steve had the link up there. Just click on it. You'll see at the bottom, I think it's $5,000. It's not a lot. I know some people like to start with a smaller amount than that, but you can't trade too much with options with too much less than $5,000. And I encourage you to start really small. I encourage you to start with not more than $5,000. $5,000 is a great starting number, if you ask me. Jay Mart says, at what point do you adjust your credit spread that's in trouble? Certain delta, money loss, etc. Yeah, I like to look at the short strike. Once the stock price has permeated that short strike, there's where your ears should prick up, and there's the red flag that says, I better take some action. That's a pretty simple red flag, line in the sand right there. Rick T says, do market makers stand aside in the 10 minutes before close on earnings day trades? Well, they don't stand aside, but they're a whole lot more careful, because here's what happens sometimes on earnings day. Like I said, guys, I used to be a market maker on the floor of the CBOE. And here's what would happen sometimes when we'd be standing in the pits. It would be like the day before earnings, and some big brokerage firm in the last 2 minutes of the day would come and want to buy 10,000 calls. And, if I sell part of that. If I sell like 1,000 calls and I get all this negative gamma, risk of the stock moving, I mean, I could lose, $100,000. I've got to be careful. If my position is pretty flat, I want to stay pretty flat. So, the market makers don't totally stand aside, but they want to make sure they're not getting run over. Jim says, isn't an iron condor both a call credit spread and a put credit spread, Jim? It's both of these spreads we talked about today. Call credit spread and put credit spread at the same time. Yep, there you go, Invader Sim. Bruce says, will straddles be covered? No, because, straddles are not income trades. Straddles are not income trades. They're volatility trades. Robbing Hood, I like that handle there. Do you use your money to do something good in the world? Yes, I do sometimes, and sometimes I spend it frivolously. So I guess I'm just kind of like a regular person. Okay, Steve Martin says, what % return can we expect per month? That is going to vary. That's going to vary person to person. I'm not one of these guys who says, hey, I've got the best strategy in the world and I guarantee you're going to make 50% this month. I know every trader is different, has different risk tolerance, and I sure don't make any guarantees that I can't stand behind. I've been in options for 19 years. I know how they work. I know nothing's guaranteed. I'm just trying to help you guys be better traders. You know what? TB says I need a glass of water, and by golly, you're right. I'm going to take a sip right now. Thanks. JT says with iron condors on boring stocks, like I said, the implied volatility will be low and consequently the premium received will be low. Generally, how far out of the money are your short strikes in these scenarios? Awesome observation and question. Yes. See, there's a trade-off, and that's why looking at the volatility is so expensive. The volatility will be low on those kind of stocks in absolute terms, but that's why you want it to be a little bit higher than it should be, a little bit overpriced. So, I like to go as far out of the money as I can. I say, hey, use support and resistance, but I like to get a little bit more wiggle room outside of support and resistance for the put spreads. If I can get a good enough premium and go really far below support, I'm all over it. Call spreads, if I can get a good enough premium and go really far above resistance, I am all over it. Rick T says, thanks. You're welcome, my friend. If the price hits your short option, what action do you take? See, now, Tim, this is where we're getting complicated. It's situational. I would likely do some sort of adjustment. Look, the reason why a third of my 6-part class is on adjustments is because there's not just one adjustment. I don't have one answer for you. In the 6-part class, I'm going to go through many different market scenarios and many different adjustments. Peter says, will you teach Japanese candlestick? I teach some technical analysis stuff. Steve here is the Japanese candlestick guy, But I do teach some basic technical analysis that you need for income trades. So, there will be some of that, but it's not a candlestick reading class. It's an income trading mastery session. Will I teach risk management? You betcha, Peter. It's all about risk management. Mini Mike, see you later, my friend. Please comment on recent low VIX and super. Yeah. Robin Hood, please comment on recent low VIX and super low VXS. Have noticed a lot of premium in income spreads lately. Or not a lot of premium in income spreads lately. Yeah. That goes back to what I was saying before. Especially the last couple of days have been pretty tough because VIX is the implied volatility of the S&P 500, basically the market. And VXX is in that same vein. I don't want to, get too complicated here, but it's a similar concept. When implied volatility is really low, you're selling these spreads for pretty cheap. It's like the insurance company who sells, a bunch of really cheap insurance policies, and then there's a 100-car pileup. Say, holy cow! I thought I had a pretty safe bet going here, and I just got creamed. That's the stuff you got to be careful about, and that's what's going on. What's been going on is that the premiums are low, but the volatility is a little precarious. Donna says, how close to expiration do I do these spreads? Yeah, my guideline was 2 weeks to 2 months. The rule, definitely not more than 2 months, but, the closer to expiration, the better. Diane says, really great review. Thanks, and you're welcome. Dennis says, did you mention an appropriate profit to risk percentage? Yeah, if you can get 80% of your max profit, I say that's a great place to step in and just take your profits and close the trade down. Mike says, I noticed that if a stock is boring, yeah, we were just kind of talking about that. If a stock is boring, then implied volatility is a lot lower. Yeah, we need higher implied volatility to make it worthwhile. Yeah. What's the method used to filter out those that are boring? Yeah, there are some filters out there that will look for volatility disparities, like if implied is this much above historical. You can start there, but there's nothing like good old-fashioned just hand-to-hand combat, just sifting through stocks. Jean-Pierre says, do you indicate which brokers could work with credit spreads? Yeah, Jean-Pierre, any of the option-friendly ones, Trade Monster, Thinkorswim, Options Express, Trade King, who else? TradeStation has a nice new platform for option traders. So, I can't talk about what other brokerage firms do because I don't work for any brokerage firms, but the ones I just mentioned are the option-friendly ones, and I sure don't think you're going to have a problem trading credit spreads with them. Whenever you have a new broker, be a little careful to read. I'm old-fashioned. I like to call them up and talk to them. Say, hey, look, this is what I'm looking to do. Can I do this? What are your commissions? Are they negotiable? Blah, blah, blah. And there you have it. Baram says, thanks for the nice education. You are welcome, my friend. And it looks like we are out of questions. Well, thanks. Thanks, everyone. Thanks to Steve for hosting me. Thanks for all the great questions after the presentations and the interest. Looking over here on my other computer, it looks like there's a good number of you guys who took advantage of the offer. If you're interested, it's markettaker.com/SB. Just go there. SB as in Stephen Bigelow, as a matter of fact. And I'm really glad I could spend some time with you guys tonight. I really enjoyed it. I hope you got something good out of this, and get out there and trade smart.
Dan, thank you very much. These are the presentations we like to see. Very clear, concise, and very easy to understand. So I appreciate your information. And I always tell people on these sessions that pick up stuff that you can add to your own trading. It might not be somebody's complete program, but if you can find bits and pieces that you can add to your trading to make you that much better, it's going to make you a lot of money in the long run. So appreciate you coming tonight, and thank you, everybody, for coming. We'll see you in the chat rooms.
Thanks, Steve.